And back with more of The Real Money Show. The number to start investing is 1-877-8-SILVER and therealmoneyshow.com. With us now, Dr. Paul Craig Roberts, one of the most respected columnists in the alternative media spectrum. His syndicated articles have been seen on many leading alternative news websites, including InfoWars and Counterpunch and King World News, countless others. Former Assistant Secretary to the U.S. Treasury under Ronald Reagan's administration, and he held the position of editor of the Wall Street Journal. He has written several books, including The Tyranny of Good Intentions and How the Economy Was Lost, as well as the one you should pick up for sure, The Failure of the Laissez-Faire Capitalism. There's no one better in reporting the reality of geopolitical events and the workings of the Treasury and the Federal Reserve. We are very pleased to welcome Dr. Paul Craig Roberts.
Well, Dr. Roberts, welcome to the show, The Real Money Show, and it's a pleasure to have you here. We've been following you for some time, and of course, you've got a lot of material out there. I wanted to get through a few questions today with you, and the first question we had is regarding how the markets in precious metals have been very cyclical, at least as far as our opinion of the markets has been. We've been around since 2002, and we've discussed on our show, which has been on air since 2008, how cyclical since the beginning of this bull market gold and silver have really been. How would you explain the most recent correction in the gold price since 2011, and what factors have played a role in getting us to where we are right now?
Well, I wouldn't say it was a correction. I would say it's an intentional manipulation by the Federal Reserve using its agents, the bullion banks, to suppress the price of gold because the rising price of gold was threatening the exchange value of the dollar. The dollar was under pressure because of the Federal Reserve's policy of quantitative easing, with the Fed's balance sheet expanding from approximately $800 billion to $4 trillion. This had caused a great deal of concern among dollar holders around the world, including foreign central banks and the Chinese government, that the supply of U.S. dollars was growing dramatically, but the output of U.S. real goods and services were not. And therefore the question arose of the dollar's value. And gold was an indicator. The strong rising price of gold over the decade was an indicator that confidence in the dollar was disappearing. And so when gold hit $1,900 an ounce, we saw the beginning of large-scale short selling of gold in the futures market. And what gives this manipulation away is that it's always in the least busy part of the gold trading day that massive shorts are dumped on the market, and no one would abandon a position in that way. It's a way of getting maximum decline in the price of what you're dumping. So these are conscious manipulations. They occur when there's most times they occur when there's no real news to explain a drop in the gold price. And they occur in the least busy times of the market when large numbers of contracts can have the most effect on the price. So it's not a cyclical correction. It's a manipulation to protect the dollar from quantitative easing.
Right. Well, here with Dr. Paul Craig Roberts. And Dr. Roberts, in an interview you recently conducted with King World News, you discussed what has been a prominent theme for us here on The Real Money Show, and that is the idea that much of the touted growth in the U.S. economy has actually been a result of companies buying their own stock, or more appropriately labeled corporate buybacks. It's, in our opinion, it's become very rampant. And I'm curious as to whether or not we've witnessed such a situation any other time in recent history, especially to the extent that these corporate buybacks are happening now.
Well, I wouldn't know that, but I do think it's certainly unusual, and I would bet that probably we've never seen the extent of these buybacks. I think there was a report out recently, and it showed the buybacks were over $4 trillion in the last few years. And I think in this last year, they were almost $1 trillion. Anyhow, there's a report out on that. It's
right.
Not speculation. It's so when you add the corporate buybacks to the amount of money the Fed dumps in the banks, which some of which certainly must gets used in speculating in S&P futures, you can see that the stock market is a huge bubble. And what's also disturbing about the buybacks is that the companies, the corporations, apparently have gone beyond just using their profits or their money in the bank to buy the stock, but actually borrowing from banks in order to purchase their own shares, so that they are accumulating debt without accumulating additional plant and capacity to produce goods to earn profits with which to service the debt. So in that sense, it's doubly worrisome.
This kind of leads into the notion of the art of misdirection. And for us, we've discussed the theme at length, actually ad nausea, in terms of this misdirection. Of course, its most common form is the headlines that get touted day after day, week after week, which are quite frequently adjusted to reflect the data which is more accurate after the time of posting. But it feels as though the U.S., and to a great extent the global economy, is really becoming increasingly unstable behind those headlines. What is your take on the real situation of the U.S. economy, and what, if any, impact long-term will there be on gold and silver and perhaps even the middle class?
Well, I think the middle class is being systematically destroyed. It began with the collapse of the Soviet Union when India and China changed their attitudes and opened their large, underutilized labor markets to Western capital. And corporations, Western corporations, particularly American ones, found they could greatly increase their profits by lowering the labor cost. And they also found that they were under pressure from Wall Street to close their manufacturing facilities in the U.S. and move them abroad, and were actually threatened with with Wall Street financing takeovers if they didn't produce greater profits by offshoring their production for U.S. markets. And, of course, the result was to destroy a vast amount of manufacturing jobs that provided the middle-class income. And then with the rise of the high-speed Internet, the same thing happened to tradable professional services such as software engineering, research, design. All of this could be done elsewhere and sent in on the high-speed Internet, so that the kinds of jobs that provided the ladders of upward mobility in the United States, that produced the Opportunity Society, these jobs simply disappeared. And for years, as I have reported, usually each month, the payroll job numbers show that the only jobs that the United States can create are lowly paid, domestic, non-tradable services, waitresses, bartenders, hospital orderlies, retail clerks. And so, essentially, the economy is ceasing to exist. We are on the road of becoming a third world economy in which people are employed in lowly paid domestic, non-tradable services. We see this also in the changing composition of jobs between full-time employment and part-time employment. Increasingly, jobs are part-time. And therefore, the prospect of improving one's position in life that defined the United States as an opportunity society, this prospect is closed.
That's a very interesting point, because if you think about it in terms of the middle class, what, in your opinion, would help to turn this around or rebalance, shall we say, the system? I mean, do we have to have an all-out falling apart of the economy, or what is the way in which we can see some light at the end of the tunnel?
I don't think it can be turned around. I think a collapse will eventually come. Theoretically, you could turn it around if you changed the way you taxed corporations. For example, if you taxed corporations according to the geographical location in which they produced the goods and services, and gave them a low tax rate if they produced domestically in the United States and a high tax rate if they offshored their production, you could offset the labor cost advantage and force them back. But you wouldn't be able to get that passed because corporations are a powerful lobby.
Right.
And therefore they would block it. And you could also improve the financial situation, make it less crisis prone if you re-regulated. If they brought back the Glass-Steagall Act, if they brought in the regulation of derivatives, which the Federal Reserve, the Treasury, and the SEC blocked during Brooksley Bourne's time when she was the head of the Commodity Futures Trading Corporation.
Mm-hmm.
If you again put strict limits on the position of speculators in commodity markets, so that they could not dominate those markets, but merely perform the traditional function of smoothing the price over time. And if you restored the strict limits on debt leverage, you could deal with financial disasters that have resulted from financial deregulation. But again, you couldn't get that passed. The banks are too powerful. More, they control the Treasury, the Fed, the federal regulatory agencies, and their campaign contributions control the government. So what you can theoretically do, you can't practically do, because the government is no longer responsive to people. It's responsive to a handful of powerful interest groups that simply buy the government.
Okay, guys, we'll take a short break. Stick around. We got more of this interview with Dr. Paul Craig Roberts coming up. The number, by the way, to start investing is 1-877-8-SILVER and therealmoneyshow.com. And back with more of The Real Money Show. The number to start investing, you know it, 1-877-8-SILVER and therealmoneyshow.com. We are back talking with Dr. Paul Craig Roberts.
It's a scary thing to be in this position, but from our perspective here up in Canada, we're watching with great intent on knowing exactly what that outcome might be, of course, because as you can imagine, we have not, as a country, experienced quite the same type of economic downturn. And although some things are very similar, we are certainly advocating as a firm the ownership of physical gold and silver. What are your views in terms of ownership in things like gold and silver or other hard assets, period?
Well, traditionally, gold and silver have been inflation hedges. They don't make you rich, only in nominal terms, but they prevent you from losing wealth from inflation. And so that is a fact. It's a historical fact. It's also true, in my opinion, that the United States dollar is overvalued because the creation of $4 trillion new dollars during quantitative easing, or $3 trillion or whatever, $3 trillion, I think, this increase in dollars was not matched by an increase in U.S. goods and services, and so it has to affect the exchange value of the dollar. And then we also see the dollar being affected by people moving away from using the dollar payment system because the United States abuses it. It uses it to impose sanctions on countries that don't do as Washington orders, for example, the Russians. Mm-hmm. And we see then the Russians abandoning the use of dollar in energy transactions, the agreement they've made with China. We see now, last week, the Russian and Indian central banks are working out arrangements so that their trade between themselves no longer involves dollars. We see the formation of the BRICS to avoid the use of dollars, and therefore the demand for dollars in foreign exchange markets is headed down. And how long Washington can prevail on its puppets, Japan, the EU, to create their currencies with which to purchase dollars in order to support the exchange value of the dollar. This can't go on forever without these countries suffering the consequences themselves. So I think that a substantial drop in the exchange value of the dollar is in the works. I can't predict when it will happen, but it's there, waiting, and therefore you would be far better to be holding wealth in gold or silver than in dollar-denominated paper assets. On the other hand, you can't take for granted that governments won't confiscate your gold holdings.
I mean, there's a track record there for sure.
Right.
You're speaking about the geopolitical front, and we are witnessing countries move away from the U.S. dollar. Russia, China, and obviously the BRIC nations, certainly more recently. Is this a sign of things to come, and do you feel as though this might be one of those types of events that could drive gold and silver pricing higher, or more importantly, even gold prices specifically? Well,
actually, there are plenty of forces already at work driving gold and silver higher. We've been witnessing a very strange situation that during a period when the price of gold is determined in the futures market, not in the markets where people take physical possession.
Right.
And we've been watching the actual demand for physical possession to rise strongly while the price has been falling. Now, the only way you can make any sense out of that is that people are not abandoning gold, but that the Federal Reserve, using its bullion banks as its agents, is driving down the price of gold with these naked shorts in order to protect the dollar. So I think that, and you can see whenever the shorting stops, gold jumps $20 and starts up, and then in come the shorts again. And so I think there are plenty of forces already at work to drive up the price of gold. In my opinion, it would be far above 2,000. It was already 1,900 in 2011, except for this consistent policy of using the futures market to dump enormous amounts of shorts at the least busy time of trading to suppress the price of gold. So these forces are already present. The question is, how long can they continue to be suppressed by the manipulation in the futures market? Apparently, the reason for this futures market manipulation is that the old way of suppressing the gold price, which was to police gold holdings, the bullion dealers who sold them to suppress the price of gold, apparently they used up all the gold. We can see that in that the Federal Reserve was unable to deliver any of the gold held in trust for Germany. It's also indicated by the fact that no one, not even members of Congress, can get an audit of U.S. gold holdings. People aren't even allowed in to see if there's any gold. So it looks like the use of the futures contracts to manipulate the price had to be employed because there's simply not the gold stocks any longer to use sales from official holdings to suppress the price of gold. So the question then comes, at what point does the absence of sufficient gold in the West to make delivery, or what would happen if, suppose the Chinese simply came in and bought enormous amounts of COMEX futures and then demanded delivery? If delivery couldn't be made, then you would see the whole system fall apart. So I can't say when these changes will happen, but we can see that clearly it looks like desperate last-ditch activities by the Federal Reserve to protect the value of the dollar from its own policy, which is directed at saving 4 or 5 large banks.
And that is something that's very, very curious in terms of understanding, because, of course, data is really delayed in the COMEX market, and you certainly can't always see what they're up to from a day-to-day perspective per se. But the idea that this would come to a moment that could border on collapse is something that I'm sure many from hedge funds to very well-invested countries like China in gold markets, they understand this. And I think they know. I mean, I've read at length lots of articles that discuss what little amount of delivery would actually cause the COMEX to fail. And I'm led to believe and understand that as little as maybe 4 or 5% calling for delivery would literally blow the COMEX apart. So it's a very interesting situation, and certainly we're not here just to speculate on what gold or silver might do, or other metals for that matter, but it is an interesting topic. Now, in your book, I'm here with Dr. Paul Craig Roberts on The Real Money Show. In your book titled The Failure of Laissez-Faire Capitalism, you talk about flaws in current economic theory and practice, and you do state that, and I quote, economists have failed to understand that infinite growth in a finite system is impossible. What do you feel it would take for the average person, or investor, if you like, to realize this statement? Do you feel that if the mainstream understood this point, that it might alter the way they distribute their wealth enough that the middle class might actually begin to grow substantially?
I think if that statement was understood, there would be a lot of forward thinking and forward planning. It wouldn't be on the next quarter's profits or the next hour's trading profits by front-running trades or something. Because what that statement means is that the model that exists and has existed officially since, I guess, World War II, the aftermath of World War II, that economic development is the solution for everything, and that every country can obtain the kind of high consumption levels that the United States had until recently. There just aren't that kind of resources, and there aren't that kind of sinks for waste. I mean, we already have substantial air, water, land pollution. And the basis for economic theory is the Stiglitz-Solow production function. That's named after two Nobel laureates, Stiglitz and Solow. And
Right.
This production function assumes that man-made capital is a perfect substitute for nature's capital, so that you never can run out of resources. Well, this, of course, is in direct conflict with the laws of physics, and so if you are faced with using up resources, and we also know we have massive external costs that are not included in the cost of production. For example, all the dead zones in the Gulf of Mexico that result from the runoff of chemical fertilizers. Those dead zones, the cost of these dead zones, are not included in the cost of the agricultural products that are raised and sold from the use of the chemical fertilizers. So wherever you look, you see enormous cost imposed by productive processes on nature and on third parties. And these costs erode, use up, destroy the environment. And so, in effect, you run out of disposal sinks. And these things are never cost. They're never part of production functions. So what this realization would do, it would force the world to come together in order to create some kind of sustainable economy, not one that you can rely on to grow and raise everybody's incomes or the majority of the incomes, which it no longer does, at least not in the United States. There's been no real median family income growth for years and years. So the system, it looks to me like, is already breaking down, but if you realize this problem and you try to focus on sustainable economic activity, something that gave people the ability to exist on a reasonable level, but without using up the remaining resources that the world has, that would fundamentally alter everything. I don't think it can happen because humans are short-term animals. They think short-term. They think about what they want right now. They don't worry about, well, if everything runs out in 50 years, I won't be here anyhow. So I think that the problem will just continue to fester and get worse, and if we don't manage to set off a nuclear war, or we don't manage to set off some plague, we'll find that resource constraints stop the whole way that people think about economics now. That way will simply be abandoned because of its unreality.
Well, it's by extension, we look at also the headline data that certainly is produced by the U.S. as being kind of the indicator of the global economic positioning for where we're heading, where we've been, and what we can expect to see. Do you feel, and I only have a couple of questions left, Dr. Roberts, I appreciate your time very much, but do you feel at any point in time that given the economic climate we now see, that the trillions of dollars of debt that the U.S. has accumulated will ever be cured? I mean, is there a possible way to get through this?
Well, I think the problem is far more serious than the debt. Debt itself, for example, the federal government can always pay its debt because it can print money.
Right.
And so the question is, what is the real value that you're getting back when they pay off your bond? If the if they're doing that by inflating the currency so that the money you paid for the bond is now worth half what of the money that you paid back. So these types of things are not a problem for the government. Also, debts can be defaulted, and just like stock markets can go down, the default on debt can result in people losing money. It just means having any of these type of paper instruments when you have policies that are irresponsible, then you can lose all your money. So I think the problem is different from debt. I think that the offshoring, the financial deregulation, the ignoring that there's a limit to resources on planet Earth, that these are producing lower living standards. And the lower living standards make it impossible to repay the real value of the debts, so that the debts essentially are inflated away.
Well, that's for us a very long-term, impactful situation that's understood only after.
It could start happening right away.
I suppose it could, right? Yeah.
It just depends on how long they can keep this artificial value of the dollar there.
Right.
The manipulation. You have to understand that countries are puppets of the United States, including Canada. And if the United States wants the Canadians to print Canadian dollars to buy the U.S. dollar to support it, they'll do that, just as the Japanese do, and just as the European Central Bank does. And moreover, just about any country that wants to export when there's a dollar-based system has to print its own money to keep its money from appreciating relative to the dollar and curtailing its exports.
Mm-hmm.
So the way the United States conducts policy essentially forces the whole world to inflate.
Right.
And point, you have this growth in money that's not matched by growth in goods and services, and then the prices break loose. And that I think has always been the case. And as I think I said earlier in our conversation, it surprised me it's gone on this long without the consequences becoming apparent. But we've never seen this level of manipulation of markets before.
Right. Given and my last question to you, Dr. Roberts, given the current state of the global economic situation, and given the fact that we've discussed manipulation here today, do you feel at this point in time, if you care to give us your opinion on this, do you feel that gold represents good value at this price range?
Well, in any traditional context, it would appear that gold is underpriced in U.S. dollars, and that seems to be the intention of the Federal Reserve, and that's why it uses the bullion banks to dump these contracts. So, on the other hand, it's kind of hard to have a whole lot of wealth in gold that's not visible, and therefore you don't know what the behavior of government toward your holdings might be. So I don't think we have any secure way now to protect wealth. They can destroy it with confiscations, taxes, with laws, but certainly I would rather be holding gold or silver than paper dollars that are being endlessly created. You can't endlessly create gold and silver, and traditionally, historically, they've always been a store of wealth. And in times when paper monies are unreliable, silver is usually the means of payment. Gold becomes a store of wealth. That's historically the case, and unless there's some reasons we don't know about that have made the historical case inapplicable, I would expect that gold and silver will continue to serve in those roles in difficult times.
Dr. Roberts, it's been a pleasure to have you on the Real Money Show today. We thank you for your time, and we hope to speak with you again soon. Thank you very much.
Thank you. I appreciate your interest.
So, Darren, what do you think? Especially the closing comments, right?
Well, the important thing to note here is that this is not somebody who's a gold bug. You know, we talk about this in the gold and silver markets all the time, people who are planting, food in their backyard and building bunkers to protect themselves from the world economic collapse that's coming. This is not Paul Craig Roberts. As the intro, as you said, clearly points out, this is a man who was part of the Reagan administration as the former Assistant Secretary of the Treasury. And he's also the former editor of the Wall Street Journal. And I mean, there is real credibility behind what he is saying. And I encourage everybody to go and buy the book, The Failure of the Laissez-Faire Capitalism. And that's something that we would all probably agree on when it comes to where we're heading. The elitists are controlling this system. Gold and silver represent roadblocks to their inevitable total control. And they are trying to very aggressively keep the price of silver and gold down, as he said in his interview. But along with this, there are another, gazillion factors that play a role in determining where gold and silver go. So the takeaways from this for me are really simple. Yes, gold represents good value traditionally based on where it's been. We don't know to what extent the price might continue to be manipulated, but if you are an investor, these are assets that this type of man, who's a very, very well-respected individual, suggests you own, as opposed to owning paper assets with that are devaluing in value.
It really doesn't matter, though, Darren. When you own gold and silver, whether you buy it monthly and put $100 a month in it, $200 a month, $1,000 a month, and just keep on buying at the price, you can buy it, store it. You really don't have to worry about it. In the long term, it's going to keep on increasing in value, and you're going to protect your capital, you're going to protect your wealth against what's happening. There's inflation. Dr. Roberts talked a little bit about inflation, but again, they don't count things like gasoline. They don't count food when they're looking at inflation. They come up with the silliest things like hotel rooms and secondhand cars. It's crazy.
What was your opinion in the interview?
I thought, he's extremely knowledgeable. He's smart, as you said. He's not one of these nutters that's, running around in a gas mask and with tins of Spam, waiting for the world to collapse. This guy is completely knowledgeable, and he's telling you what's happening. One of the simple things is that when you look at the economy and you look at the stock market over the last 3-4 years has really gone up tremendously. This is due to QE, which is quantitative easing, where the Fed was buying $85 billion a month in crap bonds or whatever they were purchasing to help the banks out. The only people that really made money is Wall Street, a lot of the big hedge funds, and the extremely wealthy. This never trickled down to the everyday John Doe investor who never got his real piece. Middle class is being eroded right now at a tremendous rate. And what Dr. Roberts basically said is, there was $4 trillion, I believe, in stock buybacks in the last 3-4 years. $4 trillion. That's incredible. So what they're doing is the executives are pumping up their own stock to get the, great bonuses or whatever. But this money is being borrowed from the bank at zero. There's no capital expenditure. There's no equipment. The jobs are still, manufacturing is still done abroad. And he's basically saying that.
And he's basically saying that this is the unwritten policy of the Federal Reserve of the U.S., and that's a scary notion. And one thing we suggested, what could turn it around? Ownership of assets like gold and silver.